Hello, this is Alicia Sisk-Morris, and I'm representing Team Echo today, and I will be presenting the cash flows statements presentation for the Western Carolina University's ENT 640 Summer 2015 class. Is this how you envision cash flow? Just piles of dollar bills flowing out of the accounting department into a big basket of cash? Or maybe this is how you envision the cash flow model. Lots of people doing lots of things, money flowing in from different venues and flowing out to different venues, leaking here and there, and lots of people trying to fix it, but nobody's 100% sure what's going on. It's a little bit of organized chaos. Is that your vision of cash flow? Let's take a look at what cash flow actually is. Cash flow is a statement that is one of the four main financial statements for a business. Those statements would include the balance sheet, the income statement, the cash flow statement, and the statement of stockholders' equity or owner's equity. The cash flow statement reports the cash generated and used during the time interval specified in the heading of the report. The period of time that the statement covers is chosen by the company. So, for an example, we could say that this cash flow report will encompass the fiscal year that ends in December the 31st, 2014. That's pretty common for a calendar year business or an individual. Your fiscal year will start January 1 and end December 31st, 2014. Other organizations may have different fiscal year end dates. Some end at the end of the third quarter to coincide with the federal government, and some end at the end of the second quarter to coincide with state government. The cash flow statement organizes and reports cash generated and used in the following categories. The first category is operating activities. This area converts the items reported on the income statement from the accrual basis of reporting and accounting to the cash basis. The second area is investing activities, and this reports the purchase and sale of long-term investments and property, plant, and equipment. The third area is called the financing activities area. And in this section, we'll be reporting the issuance and repurchase of companies' owned stocks and bonds, as well as the payment of dividends to stockholders. The final section is called the supplemental information section, and this will report the exchange of significant items that did not involve cash, and reports the amount of income tax paid and interest paid. So where do we enter the balance sheet changes? If there is a change in the balance sheet category of current assets, those changes will be reported on the cash flow statement in the operating activities area. Same thing for the current liabilities. Those changes will also be reported in the operating activities area. Changes in long-term assets will be reported in the investing activities section of the cash flow statement. And the long-term liabilities and stockholder equity changes will be reflected in the financing activities section of the cash flow statement. Here is an example of a balance sheet. We will be looking at the Good Deal Company's balance sheet that is reflecting between December the 31st, 2013 through June the 30th, 2014. Please note this is a new startup company. As you can see in their balance sheet, they have zeros in all the categories for December 31st, 13. So this report and the numbers that we'll be looking at will reflect the first 6 months that this business has been in existence. Here is the cash flow statement. let's take a look at some of the numbers. First, in the operating activities area, we will include the net income for that 6-month period. In this case, it's $280. Please note that $280 is the same $280 reported here in the owner's equity section of the balance sheet. Next, we will add back in depreciation expense. Depreciation expense does not affect cash, and therefore, since it's an expense in the income statement, we're going to need to add it back because cash was not expended in order to experience that expense. We're also going to subtract the $200 in inventory as well as the $150 in supplies. Those items are over here on the balance sheet and reflected here as an asset being held. Since the money was spent in this period, we have to reflect that the money was spent on the cash flow statement, even though it's sitting as an asset on the balance sheet. We'll also show that there was a purchase of equipment, some office equipment, for $1,100. That item will be subtracted here because that item is considered an asset and is sitting on the balance sheet here. Finally, we will add in the influx of cash that came from an investment from the owner. And once you total all these numbers up, you will see that we have a net increase in cash of $850. This should match the beginning cash, and subtract it will match here, the end of cash, $850. That number will match the $850 going from 0 to $850 here. So look, here's the year beginning, here's the 6-month period ending, and see how those numbers match this 0 here, this $850 there. Here's a few points to ponder regarding cash flow. According to Sir David Tang, a Hong Kong businessman, the 3 most dreaded words in the English language are negative cash flow. According to John McKee, CEO of Whole Foods, he reflects that he believes for any small business that is bootstrapped, the overwhelming challenge initially is to get to positive cash flow. Currently, it takes a new business usually about 3 years to get into black or get into positive cash flow, but some businesses like restaurants may take as many as 5 years. What you need to take in consideration is that during that 3 or 5 year period, the owner is not going to be pulling money out of the business because the business will not be profitable. So the owners or stockholders or investors are going to need to be able to live on other funds that they have saved or other income streams that they may have available so that they can keep the money in the business and so it can grow and eventually gain a profit, and then they'll eventually be able to pull out either dividends or salary from the organization. So those are things to keep in mind when it comes to cash flow. So how do you learn more about accounting and creating these type of reports? Well, you could take an accounting class. You can go to a local university like Western Carolina or UNCA, but you can also take some for credit and non-for-credit classes at your local community college like AB Tech. There is software available that will assist you in creating these financial reports and help you calculate them. I currently teach a class on QuickBooks 2015 through AB Tech's class, and that's another area where you can learn a little more about reporting and entering information in an accounting software program. And here is some reference materials for you for this class that I referenced. You can get some textbook support, QuickBooks, a link to AB Tech, as well as some additional online accounting education. I hope you find this helpful. If you have any questions, certainly feel free to reach out to me. This is Alicia Sisk-Morris. I'm a CPA located in Weaverville, North Carolina. Take care.